So you want to grow your wealth by contributing to an individual retirement account. That's a very smart move. In this video, we are going to talk about IRA contributions and pretty much everything that you could possibly need to know about them. Now, there's definitely a lot more to individual retirement accounts and the rules associated with them that are going to go beyond the scope of this video. But when it comes to contributions, I think that everything that you need to know should be covered in this video. And if you have any other kind of questions, please feel free to leave them down in the comments below and I will answer them as soon as possible. The first thing that I want to talk about while we get started is what an individual retirement account is. What is an IRA? Just so we're all on the same page here. Well, an individual retirement account is an account, usually a tax-advantaged account that incentivizes you to save for your retirement. Now, it is generally designed to save you money on taxes while also allowing you to save for when it comes time to retire. And there are two main different types. And there is the traditional IRA and there is the Roth IRA. And the contributions are quite different between the two. So with the traditional IRA, what happens is if you do not go past the income level and you're allowed to take a tax deduction, so you contribute to the traditional IRA, and then the money that you contribute to that traditional IRA becomes not taxable. So it becomes a deduction of your income. So let's say you made $50,000 and you contributed $5,000 to a traditional IRA, then you would get a $5,000 adjustment or a tax deduction, and you'd only pay taxes on that $45,000. And while the money is in the account, you can invest it and the earnings grow tax-free. So if you get paid dividends within the traditional IRA, you don't pay any income taxes on the dividends, but they also stay in the account. Same thing with capital gains. If you buy and sell different stocks, and there's usually capital gains associated with that or capital losses. So none of that counts against your personal income while that money remains in the account. So it grows tax-free. And then when it comes time for you to actually withdraw from it, say if you're actually retired and you withdraw money from your traditional IRA, then that money is taxed at whatever the tax rate is now. So basically, traditional IRA, you defer taxes now, it grows tax-free, and then you pay taxes on it when you go to withdraw that money. Whereas on the other hand, a Roth IRA works a little bit differently. So money that you contribute to your Roth IRA does not count as a tax deduction. So if you made $50,000 and you contributed $5,000 to the Roth IRA, you still pay taxes on $50,000. You don't get that adjustment, you don't get that deduction. While the money is in the account, just like with the IRA, the traditional IRA, the money grows tax-free and just the same way. But when you go to withdraw it later on when you actually are retired, you don't pay taxes on it. So basically, you pay taxes now with the Roth IRA, you pay taxes now, it grows tax-free, and then you withdraw it tax-free. Whereas the traditional IRA, you avoid taxes now, it grows tax-free, and you pay taxes on it later. One of them can be more beneficial to you than the other. It just really depends on your situation and what you think the future is going to be. You might be asking, which one is actually best for you to grow your net worth? And I cannot answer that question right now because it highly depends on your individual situation. Because when it comes to IRAs, like I mentioned before, there are so many different rules. There are phase outs to where if you make too high of an income, you can't take a tax deduction or you can't even contribute to a Roth IRA to begin with. There are many different rules when it comes to them. So just to answer, which one is best for you is beyond the scope of this video. It's going to take a lot more research to determine your individual financial situation and which one is best for you. But I can tell you the method that I personally use and that I think is a smart move for me. And it might also apply to you. I don't know. So when it comes to my personal situation and which one I see as more beneficial to me, well, I see the traditional IRA as being more beneficial at the moment because I would rather not pay taxes right now. And then when I'm actually retired, I expect to actually have a lower income than when I was fully working. And so I can actually withdraw it hopefully and pay less taxes later on down the future. But again, it can be argued that maybe tax rates will go up in the future, and so that is an actual bad move. It really depends on your outlook on the future. There is no one-size-fits-all when it comes to which is better, the traditional or Roth. Highly dependent on your situation. But we can talk about the contributions because right now, in 2020 anyway, the max contribution that you can contribute to either the traditional or the Roth is $6,000 per person. So if you are single, you can contribute up to $6,000 in 1 year to either a traditional or a Roth IRA. Whereas if you are married, you can contribute double that because it is $6,000 per person. So $6,000 for one spouse and $6,000 for the other. And so that is $12,000 off on your taxes if you filed married filing jointly. And it's also important to know that if you're over the age of 50, then you can do an extra $1,000 of a contribution. So if you're single and you're over 50, then you can contribute $7,000. And if you are married and filing jointly, then you both can contribute $7,000 for a total of $14,000. And also, when it comes to these contributions have to come from earned income. So you cannot contribute to an IRA with only income that is, say, passive, like interest you've earned at the bank, or money you've made from rental properties, or money you've made from capital gains and things like that. It has to be earned income, so it has to come from either a job or from self-employment. It has to be earned income. It has to be a wage for you to make that. So if you contribute $6,000 to your IRA, you better have actually made at least $6,000 in that year. Regardless of how much you made total, at least $6,000 of it, or at least how much you contribute to it, must be earned income. And going back to the traditional IRA, like I mentioned before, you can actually reduce your taxable income now by contributing to a traditional IRA. Granted, you don't meet the phase-out limits. Now, I will go ahead and put a chart on the screen really quick just so you can take a look at those phase-out limits. So right there you can see how much you can possibly make before you get phased out. And phasing out basically means once you reach a certain level, the amount of a deduction you get to take for the traditional IRA becomes less and less rather than dollar for dollar. And then once you get to a certain level, basically you can take no deduction for the traditional IRA. So you can still contribute to it, but just no tax deduction right now. And those rules are actually different if you have a 401k at work or not. So if you have a 401k at work, like available to you, then those phase outs apply that I just showed you. But however, if you work somewhere where there is no 401k available, then it doesn't matter how much you make. The IRA is deductible up to pretty much any one amount, and vice versa. So if you had the 401k at work, that amount of money is not subject to phase outs. But if you don't have a 401k at work, then the IRA is not subject to phase outs. So either or, one or the other, the 401k or the IRA is not going to be subject to phase outs. And talking about retirement, saving money on taxes, and growing your net worth is a really big part of the On Cash Flow channel. So I definitely invite you to subscribe to the channel if you want to learn more information about how to save money on your taxes, how to grow your net worth. Okay, and if you're enjoying this particular video, I would really appreciate it if you just hit that like button and like the video, because it really helps me out and it motivates me to keep making these videos. Now let's get back to the contributions. One thing that you really need to know is that a contribution is different than a rollover. So for example, if you leave an employer and you go to work for another one, you might have had a 401k at that old employer. And you might be wondering, what am I going to do with it? Well, you can roll it over into your traditional IRA if you already have one. And rolling over basically means you're going to take the funds from that account and transfer it to the funds of your traditional IRA. Now that rollover amount, the amount that you transfer over, it does not count as a contributions. Contributions are separate. So if you have money to roll over from a different 401k or even a different IRA at a different company or something like that, don't worry, it's not going to count as your contribution. You can still make contributions. There is a maximum amount of how much you can contribute, but there is pretty much no maximum amount of how much you can roll over. And speaking of rollovers, you can roll them over, from a traditional into a Roth, or you can roll them over from a traditional into a traditional, or from a Roth into a Roth. But getting back to the contributions, you might have heard that you can't withdraw money from a IRA until you hit 59 and a half. And generally, when someone says that, they're talking about you can't withdraw it without paying a 10% penalty. Because these accounts are designed to basically say, we're going to incentivize you to save for your retirement, and generally you don't retire until, you're in your older age. So 59 and a half is the bare minimum age where you can take withdrawals from your IRAs, both of them, without paying a 10% penalty. But there's a very important difference. So if you do take like a regular withdrawal from a traditional IRA before you're 59 and a half, you will pay not only income taxes on that withdrawal, because you deferred it before, but you're going to be paying the income taxes now, but then you'll also pay that 10% penalty to the IRS. So that's generally why you don't want to withdraw money before 59 and a half. There are ways around that, but that's beyond the scope of this video. And when it comes to that traditional IRA, you actually have to take distributions, basically withdrawals, when you reach 70 and a half. So 59 and a half, you can begin taking withdrawals if you want to, but at 70 and a half, you generally have to start taking distributions from that traditional IRA. The Roth IRA, on the other hand, is very different from that. So the Roth IRA, you've already paid taxes on the amount you've contributed. You can withdraw the amount that you've contributed to a Roth IRA at any time, the actual contributions that you've made, because you've already paid taxes on them with no penalty. But if you've made money on the amount invested in that account, such as you've made money like on a capital gain and accumulated dividends and things like that, you technically can't withdraw that money without paying a 10% penalty on that money in a Roth IRA. But contributions that you've made yourself, that's all fair game. No penalty on the contributions, also no tax on either. If you withdraw just your contributions, then you're not going to pay taxes on it and you're not going to pay a penalty. If you withdraw more than your contributions, you're not going to pay tax, but you might pay a 10% penalty on the gain made in the Roth IRA if you're before the age of 59 and a half and you don't, work some magic and figure out some of the other ways to withdraw it. And you don't have to take required minimum distributions like you do with the traditional IRA at 70 and a half. So there's definitely a lot more that goes into traditional IRAs and Roth IRAs in general, but as far as contributions are concerned, this should be everything that you need to know. And if you're interested in this kind of information about individual retirement accounts, saving money on your taxes, and growing your net worth, then I can almost guarantee that you're going to enjoy watching this video that's going to pop up right next to me about becoming financially independent in 10 years or less. So I pretty much outline in that video how you can grow your net worth exponentially through saving money on your taxes, investing your money and things like that. And I know that if you watch this video, then you're going to enjoy that video. So consider checking it out. And if you haven't already, please like this video if you enjoyed watching it, and consider subscribing to the channel because I'm putting out new information on personal finance every single week. Thank you so much for watching. I'm Zach from OnCashflow.com, and I hope to see you next time.